speakers here, and I'm joined with two of our senior investment professionals, Tu Nguyen, who's responsible for our listed equity and fixed income business, and Lin Vu, who is our head of research. And so we've spent the morning really talking about the macro picture, trade policy, certainly technology moving us forward. And so what we've talked to our clients, and one of the things that they've always asked us is, okay, it's great to learn about the economy, it's great to hear where the country's going, could you actually spend more time talking about what you guys actually do? And so we titled this Behind the Curtain. And so that, for people that are as old as me, that is a Wizard of Oz reference. For people who are younger than me, which is most people, no one had any idea what I was talking about. So for my local team, I will explain what the Wizard of Oz is later, because that, even when I explain the reference, it didn't go over too well, but it is important. So what we want to do here, go to the next slide. So we're not going to spend too much time, but this is a lovely commercial that says, hey, when we look at our UCITS fund, which is VVF, this is through September, year to date 21 versus 12.5, 1 year almost 20 versus 10, 3 year 4 versus minus 3.8, 5 year 12.8 versus 4.1, inception 11.3 versus 6.5. I think it's important that people actually say, well, how do you actually generate those returns? It's nice to talk about where the market's going, but what people have actually said is, I want you to actually spend a little bit more time talking about your investment process, talking about how you research companies. So we're going to spend roughly the next 20 minutes talking about how we do research, how we build portfolios. This is just for the offshore funds for listed equity. It's the same for our local funds. But the reality is we just really want to be very transparent in sharing our research process and sharing our approach. We talk so much about the resources that Vienna Capital has. We want to really make sure that you come away from the next couple days understanding how we do what we do. I think you understand why we do it. Now we want to spend a little bit of time on how we do it and then who's actually doing it. So the best part about this is you really won't hear much from me for the next hour. You'll hear from Tu and from Lin. Tu's very excited about that. And so,
always.
Tu, please take it away.
Thank you, Eric. Good morning, everyone. It's always a great pleasure to be on stage and have Eric sing praises about our performance. But it's a team's effort, really. And before we spend the next 20 minutes talking about the process, I just want to maybe spend 1 or 2 minutes talking about the people behind the process, because to me it's equally important. We won't be able to execute very good process if we do not have the right people in place. So when we talk about the returns, and I said that it's the team's process, I'm really talking about the 20 people in the research and investment team that work tirelessly to contribute to the ideas generation, the stock selection, the portfolio construction, the ESG assessment and stewardship, as well as the risk management that culminate in those returns. And to talk about our team, I want to say a few words about how blessed we are to have the right people with the right experience for the job. So out of the 20 people, actually 19 of us are Vietnamese, born and raised Vietnamese, who understand the economy and the business culture very deeply. We also understand the nuances of investing in Vietnam. And because we are Vietnamese, we are able to relate to people regardless of whether they are senior management of blue chip companies or founders of smaller companies. And also we have the right experience in the sense that out of these 20 people, there are 5 portfolio managers averaging about 16 years of experience. I myself have 20 years of experience, and Ling also have 16 years of experience. So amongst us, we actually have seen several business and stock market cycles within Vietnam. And our analysts, our sector analyst team of 8 people also average about 6 years of experience under the belt. And the associate portfolio managers also have about 10 years of experience. So we are confident that we are able to get the best quality information for decision, or for investment decision making, which is very important, you know, to have a successful portfolio return. Last but not least, on people, I want to emphasize the right attitude. What do I mean by that? For an investment team and research team, especially in a young stock market in Vietnam, we've always emphasized having a long-term investment horizon. We're not in the business to select the best stock of the day or week. That's long-term in Vietnam, by the way. But we are here to pick the best stocks for the next 2 years or 5 years. You can look up our portfolio turnover, and you can see numbers that support that. Our name turnover of our UCITS fund is actually only 16%, which means that we have a really long-term holding period for the stocks that we have high conviction in. The very last point on people is also the attitude that I call putting investors first. And I borrowed that motto from the CFA Institute, and I consider it very apt, considering that half of our investment team have the CFA charter. So now I'm ready to talk about our investment process, and this chart hopefully will help you visualize how we, do the investments that we do. On the screen, you'll see that it's a process from start to finish, except that there is no finish line. It's actually a loop, really, because we're constantly on the lookout for the next best investment idea. So the first step that you can see that is labeled screening is the process to distill the broad stock market of 1,600 companies into our investment universe of about 120 companies through the use of a few screening criteria, which Linh will discuss in depth later on. The second step is the company and industry research that basically employs all of these 20 people that I spoke about earlier to analyze deeply all of these 120 companies to ultimately help the portfolio managers make the selection decision to include only 25 best stocks in their portfolio. And the step number 3, which is portfolio construction and monitoring, is the step where we create an optimized portfolio from the risk-adjusted return basis for our investor by assigning the right weight to each of the 25 stocks. Monitoring, as I mentioned earlier, is a continuous process that sees us monitor not only each individual stock in my portfolio, but also those that are in the pipeline, and also the macro factors that have very large implications on stocks' performance. Last but not least, the ESG integration and risk management steps actually run across the investment process. They don't just happen after we've got the portfolio. In fact, it starts with our screening, and it runs through our stock selection as well as portfolio construction. But we'll go deeply into each of those steps as we proceed.
Okay, I'll speak a little bit about the screening process. As Chị Thu already mentioned, this is the first step in our investment process, which aim to find hidden gems, investment ideas for our universe. Through the screening, there are certain criteria for us. The first criteria is they must be out of the ESG exclusion list. We avoid certain sectors like tobacco, child labor, or weapons related. Other criteria, we screen for market capitalizations, the companies with market cap at least above 100 million US dollar, or liquidity must be at least above 500,000 US dollar per day. Return on equity, return on assets, 3 years in a row must be higher than a certain levels. In general, out of the 1,700 stocks, only about 7% of the stocks make their way through our investment universe. On an average, good brokers, they cover about 60 to 80 companies. For us, research team, we cover about 120 companies. With 7% of the market cap, what the number, in terms of the number of companies, whether it represents for the market or not, for us, our universe represents for about 94% of the total of the wholesale market cap. So it's quite large in terms of the impact on the market. I will go a little bit further into the step 2, which is a company research process. In this steps, we have a team of, like Chị Thu already mentioned, 20 people focused on our coverage. In terms of for the markets, I think we are one of the top funds that has a dedicated number of professionals focused on this process. We on a yearly basis, we conduct around 450 companies visits, plus a lot of online and offline meeting with management and stakeholder of the companies. We don't aim to be the guys sitting with desktops research. We want to go out, talk, and understand the market. We think the value we can bring is a unique strength for us, is the deep knowledge of the local knowledge in general. One of the important outputs of the research process is the valuations, the forecast, and the recommendations for the portfolio management team. And right now we look at least 3 years projection forecast ahead of us. We, in terms of the various sectors that impact our forecast, we look at the interest rates, FX rates, and commodity prices changes every day, and do sensitive analysis on our coverage to make sure we follow closely any of the latest trends. This is an ongoing process anyway, so we keep doing it along the way. One of the important integration we focus recently is on ESG scoring and engagement with a lot of companies, regulators to promote ESG practices in Vietnam. For ESGs, we also review twice a year or at any significant ESG events. On any of the models, we have to got at least 6 months review in general.
So once we've assembled a portfolio of 25 to 30 stocks, depending on which portfolio or which mandate restrictions we may have, we come to the portfolio construction stage. And in this step of the process, we consider both the bottom-up inputs, which include, how much upside to the target price the stock still has, which basically means how much return it can generate for the portfolio. The downside risk and mitigation, if any, and also our conviction level in the stock. Everything else being equal, the higher the conviction we have in the stock would prompt us to have a higher weight in the stock within the portfolio. The top-down inputs are also important because macro analysis from the macro team helps us to have views on sectors as well as the overall performance of the economy. It's very important, just now when Mike mentioned his thesis of next year's GDP growth, for instance, he pointed out the sectors that will have to charge forward in order for the economy to deliver 6.5%. And we take note of that. That's going to be infrastructure spending, that has got to be domestic consumption, and to a certain extent, maybe even real estate recovery. So those inputs actually find their way into our portfolio construction, ultimately reflecting through our exposure to the various investment themes. We also analyze government policies and any change in government policies, because clearly we've seen that actually some investors might have even said that the biggest risk of investing in Vietnam is policy risk. So to us, analyzing and understanding policies inside out help us make better decisions. Industry cycle is basically our understanding or assessment of which stage an industry is in, whether it being fast growth or maturity, because again, that has implication on how much weight we give to the sector and ultimately to each stock. We also consider the correlation amongst stocks, because it helps us decide how much exposure to have within that sector and each stocks within each sector. At the end of the day, we also have to consider the mandate constraints. For instance, the UCITS rules state that we can't have large positions above 5%, adding up to over 40%, for instance. And the goal of the portfolio is to deliver, as I mentioned earlier, the best risk-adjusted return for our investors. In terms of the monitoring, which runs across and continuously, we continuously monitor the stock, as well as we constantly revisit and review our assumptions on the economy. I think we make Mike work very hard to review his assumptions on the economic growth for the year. And also with Ling's team, we make the analysts review their assumptions on stocks and sectors constantly. Because nothing stays the same throughout the year, and we've got to make investment decisions on real-time basis. We closely watch our pipeline. As mentioned earlier, we watch the pipeline, meaning the stocks that are currently not in the portfolio, because when things change, they might become better opportunities than some of the stocks within our portfolio, and that calls for a rebalancing of the portfolio. And then last but not least, in terms of our sell discipline, I just want to highlight that we have a long-term view on the market and on stocks, and therefore our sell discipline is mostly informed by valuation, meaning that if a stock has reached or exceeded its target price and the research team has no reason to upgrade the target price, then we'll exit and find better opportunities. We would not take the risk of selling at a bad time. And then also sometimes when investment thesis changes affecting our, basically our investment case for the stock, we'll also exit the stock and buy better ones. In terms of risk management, it's also a very important process. It's a process by itself, but I want to emphasize that we instill this in our both research and investment team, that it should be a risk management mindset. And what that means is that with our portfolio team, we look at stock and immediately when we choose to include them, we also evaluate what kind of risks exist within, in holding this stock, and whether there are any mitigations. And we will always try and balance risk and return, and only choose the best opportunities based on that consideration. And for us, in terms of risk management within the investment team, the most important thing is actually to know the companies very, very deeply. And this means that we have to actually talk to the company constantly. And as Ling mentioned, we also review our model, our cash flow models, 2 or 3 times a year in order to reflect new inputs. So we hold a concentrated portfolio in most of our equity funds, and that for us is a way of managing risk as well. There's no point in spreading the portfolio over 60 companies that you do not know very well. We would rather hold 25 positions in companies that we know inside out and talk to the management very frequently. And then, as I mentioned earlier, it's the top-down and bottom-up monitoring that runs across the process. And as Ling mentioned, we do a lot of sensitivity analysis and scenario analysis to understand the risk that exists within each company. I also want to highlight that we have an independent portfolio risk team that helps us monitor the risks of the portfolio in terms of the trade compliance, the pre- and post-trade compliance. They help us monitor the risk metrics of the portfolio, such as value at risk, liquidity risk, and ESG risk, and so on. They also run the portfolio stress testing for us for us to understand, how portfolio under stress conditions will look like. And they do risk reporting, which I'll show you in a bit. So this is a risk report that we get actually from our business partner, or the fund administrator of our UCITS fund. They do cover a lot of items in this report, and they give the assessment in color-coded form. So when it's all green, it means that it's all good. But basically, they cover things like, in terms of financial risk, it's very detailed. They look at liquidity risk, they look at counterparty risk, and even hedging risk, although we do not have any currency hedging. And they look at, our firm, in terms of sustainability and succession as one of the items in their risk assessment. In our internal risk report, as I mentioned, we look at the VAR, the value at risk, the ESG, and again, it's all green, which means that the portfolio's risk is being managed very well.
I'm good.
Okay.
So, okay, I'm being prompted here. Gee, if we only had a case study that would actually walk us through each of these steps, have we prepared anything?
I'm so surprised you asked, but yes, we did prepare for it. So we would like to talk about ACB because it's actually a company, a well-run company whose chairman came here and presented last year. And it's a stock that all of our portfolio managers like very much and have in their top holdings. So ACB, here it goes. As one of the top banks within Vietnam with a market cap of close to 5 billion, liquidity at $6 million a day, and one of the best ROEs you can have within banks, this bank easily passed our screening test. And when we do our deep dive analysis in ACB, we found that it actually has one of the highest NIMs within the sector because it has a very strong retail business. It in fact is a leading commercial bank for the retail and SME segment, with these two segments accounting for 93% of its loan book. And if you understand Vietnam's banking, it means that that's where the money really is, pun intended, by the way. It's also got very solid asset quality on very prudent lending practice. It has not always been the case. So if you look at one of the bottom charts, you'll see that in the previous cycle, it used to have very high credit cost. That was due to its legacy NPL from its previously running rather aggressive lending practices. But since it has learned this lesson in a good way, since 2018 until now, it's maintained its credit cost at just around 0.5% level and significantly below industry average. What that means is that the company can have better profitability, and true enough, its NIM is one of the highest in the sector. NPL is also one of the lowest in the sector at only about 1.2% at the moment. And because of that, the company can have the best ROE. At the moment, it's about 24%, but if you look at a longer horizon, it's consistently above 20%. This is achieved without being very aggressive in its leverage. In fact, it has one of the lowest leverages within banks. So that, bodes very well for ACB's asset efficiency. The use of capital, the capital efficiency. And in terms of earnings growth, because of its strength in the retail sector, it's also delivered fantastic credit growth, which has helped its earnings growth to increase 19 times within the last 10 years. So CAGR, on CAGR basis, is about 34% per annum in the last 10 years. And if you project forward in the next 3 years, the earnings growth average would be about 15 to 20%, which to us is very attractive. And what makes a good company a good stock is all about valuation. When we look at valuation of this stock, we find that it's undemanding because at 1.4 times price to book this year and 1.2 times next year is lower than sector average. It's in line with other private banks, but it has the best ROE. And it's actually also the bank that has perhaps the highest cash dividend yield, which at the moment not many banks have cash dividend yield since they are still in a growth spurt, so saving the capital for expansion, but ACB was able to pay out dividend. And so for us, it's a really good stock. On ESG, we find that it's also ranked very high within our universe. It ranks #1 within banks and #3 within our investment universe. For banks' ESG assessment, we place the strongest weight or highest weight in governance, and this is where it scored almost perfect score. In environment is where we identified some areas where it can improve, because, for instance, this is one of the examples. For instance, it has a sustainability credit line, but we assess that it's a bit small for its size, because this credit line is only 0.4% of the total loan book. So we make recommendation to the bank to improve on this aspect. This is not to get too deeply into ESG, but we just want to show you a snapshot of our ESG rating framework. In our questionnaire, there are 220 questions. This slide only shows 7 out of that many. And it's about shareholder interest, which is the area where the company does very well. However, in one of the criteria where the company did not score full score, we were able to identify a few suggestions for them to improve. And in terms of portfolio construction, when it comes to our view towards ICB within a particular portfolio, I pick here VVF as an example. It's a UCITS fund, so there's some investment restrictions here. But when it comes to measuring and evaluating how much weight to give to ICB, we also consider ICB against other investment opportunities that we have. And we decided to give it a position that's in the number 5 position, but it's the largest weight within the banks sector. Within the bank sector is where we have 31% weight, which is the largest within the portfolio. And usually we do not exceed 35% for any single sector. So it's a slight underweight, but again for us, because we're index agnostic, so our sector exposure really is formed by our bottom-up stock picking. And it is, in this particular case, aside from ICB, we also have a couple of other banks, but generally ICB is our highest conviction stock within the banking sector.
So I'll make a comment, and then there's a few questions that came in on Slido. One is that we're doing our best to be transparent, pull the curtain back, and in doing so, providing a case study, in a sense, you're seeing just a sliver of each of the steps. So when Tu shows the fundamentals and the economics of ACB, that's 3 slides out of probably 50 that people are looking at. And so what we're trying to do is just give you kind of how a stock makes it into the portfolio. The reality is the information set that we're looking at is much more intense, much more robust, but for the purpose of this discussion, we're doing what we can to show you 1 slide or 2 for each. A question came in, and I think it's about the bottom up, but I think it's a great way to address it, which is, can you speak about sectors or subsectors in the index which you avoid, which may have led to outperformance? And so is it what you avoid, or what you buy, or is it a little bit of both?
Okay, I'm going to speak on a longer horizon, not just this particular year, but when we look at the 2022 bond crisis in Vietnam. In fact, at the beginning of the year, there were already signs that the Fed would hike interest rates, and therefore tightening monetary policy will become the norm, the new norm. So for us, we actually immediately trimmed down our exposure to the high beta sectors within Vietnam. And in that year, it paid off very well, because our alpha in 2022 was over 12% and highest amongst peers.
And so I'll kind of answer it differently. Oftentimes when people ask us about sector weights, at the end of the day, the sector weight is really more of a result of bottom-up stock selection. There are certain times, inflection points, whether it was COVID or 2022, that macro matters more. And we're very fortunate with Michael and the team. We have excellent macro resources to help us at those key moments, but also a great research team and portfolio managers when it's really about dispersion and stock selection. So sometimes you get alpha for different reasons, and we're, I think, blessed to be in a position with resources for both.
Yes, yeah, and I mean, we can show the performance in a line chart maybe later this afternoon, but you can easily see that we've outperformed the market in both up and down market.